Hit it. It's Friday, April 19th, 2024, episode 237. I'm Kevin Muir. This week, Patrick is missing in action as he is turning 50 and probably already a dozen beers in, so it will be an interview-only show. But don't worry, it's a good one with Dayan from Macro Musings with Danny D on set. We have a terrific discussion about how the Fed has lost control of financial conditions, why inflation will be higher than market expects in the coming years, and he shares a way to hedge your portfolio for an outlier risk that's keeping him up at night. Let's get to the interview. It's our great pleasure to welcome to the show Danny Dayan, the author of the Macro Musings by Danny D. Danny, thanks for coming on.
Hey, thanks for having me. Big fan of your show.
Oh, thank you. And listen, I just found out you're a fellow Canadian, so this is going to be great. Before we talk about your great views on the market, let's talk a little bit about who you are and get to know you a little bit better. You were just telling me you grew up in La Belle Province, Quebec, in Montreal. Tell me a little bit about your upbringing.
Yeah, so I'm originally from Montreal. Grew up with a very close family in a little tiny Jewish community of Montreal. One of the things I think that really is a good illustration of what my character is was, as a kid, I was a competitive tennis player. I played not only tournaments throughout Quebec, I played throughout Canada as well as internationally until the age of 14 when I unfortunately hurt my back. And it's a big driver of my personality is the term people or my friends use about me is I'm a competitive psychopath. And I'm competitive about anything and everything. Although I've moderated it from how I used to be as a kid, that still is how I operate and what drives me. And so, that was a big aspect of my childhood, but has really carried forward, in all aspects of my life.
So what did you do when you hurt yourself playing tennis? Did you switch sports?
I did. I would play basketball for fun. I would, when I got to 18, I started doing weightlifting and I got really into that for a while.
Yeah.
I still lift, but not as seriously as I did back then. I've always been someone that has been active in sports and physical activity, but just couldn't compete the way I could. I can play tennis now. I can play, I play quite often with my father, and that's great that I can still do that. But the competitive side of things is what, stopped me. I had a curve in my spine, unfortunately, as I was growing that prevented me from competing.
So here's a question for you that might be a little controversial. Pickleball or paddle?
Pickleball is really fun. I like pickleball.
Have you tried paddle, which is kind of in between squash and tennis?
I haven't. Although I'm good at all racket sports. I'm actually a really good ping pong player, believe it.
Oh, there you go.
Yeah.
At our club, we have a tournament, and basically our club, we have squash and tennis, and then we have ping pong as well. And that kind of ends up being like the squash players win the squash part, and then the tennis players win the tennis part, and then it's ping pong that sets the champion for the whole the whole club. And before we go on too much, you mentioned that you're from Montreal. I'm going to ask you another controversial question: Saint Viateur or Fairmont in terms of bagels?
Yep.
Yeah.
Saint
Which
Peter.
one?
Yep.
Yeah. You think?
I do. They're the classics. and I'm sure you're familiar with smoked meat. Schwartz's smoked meat in particular, or Dunn's. They're both really good.
Yeah. So if anybody's in Montreal, make sure you do all of those things. Go check the bagels and also the smoked meat. All right. So you're in Montreal, you go to university, and then you get a job out of university in risk management or something of that nature.
Yeah. So actually, when I went to school, I anticipated that I was going to go into law after.
Oh.
And I just studied business because my father, was an entrepreneur, and I wanted to, learn that side of things. But I really did think I was going to go into law. And when I graduated, I had an offer to go to law school. But I subsequently, during school, really fell in love with derivatives when I took a derivatives pricing course, and subsequently got an offer in New York to work at a risk management software firm that did consulting work for large institutional clients on how to best hedge exotic option portfolios. And, since I had just started learning about derivatives and really was passionate about the markets, I jumped at that opportunity and moved to New York without knowing a soul in the city.
And did you have a math background at all? Like, because that sounds pretty mathy. What is that, in the early 2000s? Have I got the time right?
Yeah, it would have been about 2005.
Okay.
And I had I didn't have like a empirical math background or anything like that, but I was strong in math. I always was strong in math.
And was this like custom built software? And who were you guys, consulting with? Was it mostly buy side, or did you also do some work for the sell side?
Both, actually. So it was a company called Murex, and they have a full front to back risk management software system that encompasses the entire trading operation, everything from, pricing, trading, risk, reports, operations, things of that nature, all through their system. I was a front office consultant that was working with large institutions. So I covered one of the largest hedge funds in the world at that time. I also covered a large Canadian pension, a large Canadian bank. So I actually got exposure to, these different types of organizations and how they all operated, which was, a great experience. But for me, the really valuable, experience from this period was the product knowledge. I got to learn about really complex derivatives, even, things that aren't traded frequently these days. The GFC changed quite a bit,
Right.
but was able to learn, the products themselves, how to derive them. And I was advising clients on how to hedge at the individual trade level. It could be a strategy level, could be, someone who's in charge of an entire asset class in an organization, or all the way at the top at the C-suite level as they were looking at firm-wide risks. And each of these levels has a different framework to utilize. So it was actually very influential for me in having that risk management framework, because it's carried forward in every aspect of the industry for me, is to have that risk management framework.
Was it derivatives of all types, like equities, fixed income, currencies, like across the board, like swaps, options, everything?
Everything. My expertise was equity and fixed income derivative.
All right. And so you do that, and eventually you decide that, what do you want to kind of get on the sell side, and you go back to school, if I got that right?
Yeah, so I did that for 3 years, and I started to gravitate towards what my clients were doing. And also at that time, Bear Stearns had started happening, and there were a lot of things happening in Wall Street and in the markets and in the economy. And I just remember whenever I would go visit a client and sit with them, I was almost picking their brain more than they were picking my brain. I was more interested in what they were doing. And so during this period, I was actually doing my CFA. I completed that and then decided to go for my MBA. I went to University of Chicago and landed there actually, coincidentally, just as 2008 hit.
Well, actually, you know what? It's not the worst place to be for a couple of years.
Great timing.
Yeah.
It really was great timing. Not only because I got to sit out some of the messiness, selfishly, but also because, frankly, I was able to pick the brain and learn from, Nobel Prize winners, central banking experts. I had a professor who was on the Fed Board of Governors and left to come back to academia. I was able to learn, about all these policy making decisions that they were doing to save the financial system in real time, every week from my professors. JP Morgan's head of interest rate strategy flew in once a week to teach a course. Wow. I was able to learn from him. So, what I learned in school was, I think miles away from what I would have learned from experience on the street, and really in a very complex time. So that's really been influential in my career.
Who were some of the big names that were teaching? Like, would I recognize any of them?
Randall Krosner.
Oh, yeah, okay.
The Fed governor who rejoined, academia. Goolsby. I didn't take a class from Goolsby, but he was there.
Right.
So as an example, everyone knows, the famous Eugene Fama.
Right.
Obviously, there were others. Terry Belton was the head of interest rate strategy at JP Morgan. There were more complex, regression analysis and quantitative finance classes where we were pricing things like variance swaps and all, those products. So, it's quite a pretty diverse. University of Chicago has, I think, the most Nobel Prize winners of any top university in the country, and obviously is very focused on economics. So it was just really influential for me to be there, at that time.
So a Montreal kid moves to New York and then moves to Chicago. I got to get your opinion. Which city did you like best?
Chicago.
Really?
By a mile. I
Why is
love New
that?
York. I love New York. I had the time of my life there, and I actually moved back after I graduated.
Right.
I took full advantage of the social life in New York, and in my young 20s, I loved it. The vibrant nature of the city of New York, where there's always something to do. I loved it. But at the same time, Chicago was more with the Canadian personality, I think, in
Oh,
terms
okay.
of
Yeah.
a little bit more laid back. The people in Chicago, you still had the hustle and bustle, but it was a little bit more laid back. And frankly, the city is just extraordinarily beautiful. Very newly built. All the buildings are brand new. The infrastructure, it's less dirty than New York.
Yeah. I'll tell you this. I always love the Chicago pit traders. There's just no shit about them, and they're just all, they tell you how it is, and they don't get upset about having another opinion, and the people are lovely. So I'm with you there. Okay, so you graduate from this prestigious university. What job do you get out of school?
So I actually had two opportunities after school. One was single stock options trading at Deutsche Bank, and the other was Credit Suisse in rate sales. And ironically, even though I wanted to be a trader, I chose the rate sales path
Okay.
because to me, macro was what I was becoming passionate about. And it was the eye of the storm in what was going on in the economy. So to me, I wanted to learn macro. I went to a great, rates team at Credit Suisse. I think we were something like 50 salespeople and traders at the time. Great team, great group of guys and women. We were, a really hardworking team. I quickly became known as a volatility expert. One being probably one of the more quantitative guys on the sales desk.
Okay.
And I developed a reputation as someone who came up with his own ideas. I wasn't calling clients every day saying, 10-year yields move 5 bips. Here's why. I would probably go a couple weeks without even calling a client, which is not the typical salesperson.
Right.
But when I did, I usually had something big picture for them. I'm the associate that walked into the chief economist's office and said, "You guys are thinking about quantitative easing all wrong." And I then turned around and made really large, big picture calls and designed trades for them in the option markets that made a lot of money for my clients. So I got a reputation as someone who took clients that had never done business with Credit Suisse and rates, and through partnership and execution and education with them, taught them the rates business at a time it was very important, and turned them into substantial accounts for the firm. It was a great experience.
All right.
Unfortunately, towards the end, there was a little bit of politics in
Oh, yeah.
Credit Suisse, and it started to happen at that time when Basel III and Dodd-Frank was happening, and so the businesses were starting to shrink a little bit. They were looking to cut resources. People were fighting for resources. And I was just never going to win in that political game. So, I was happy to put my hand up when that opportunity came and
Right.
kind of leave the sell side.
Okay, before we get to that, I have a question for you on the sell side. And a lot of those big hedge funds that trade, we all kind of know who they are, the big macro funds, often out of London, that are trading solely rates. And they're structuring trades that are very specific. And I'm always kind of wondering, in terms of those great trades that they do, is it more a function of their call, or is it a function of finding mispriced options in terms of what the market is expecting for the distribution of outcomes going forward?
I think it's both. I think if you go back to the post GFC, environment, one of the things that we had was very steep forward curves. Something that we clearly do not have today.
Right. We have the opposite problem today.
Right. And we had actually, a lot of deleveraging in the system from the housing bust, from, banks having to delever as a result of the regulation changes. The government tried to a little bit of austerity for a year, didn't really last long. But you had substantial amount of deleveraging. You had disinflationary demographics or deflationary demographics even. And so, my highest conviction view at the time, everyone thought QE could lead to hyperinflation, or there were clients who were, happy to try and bet on gold going to 3,000 at the time, it was obviously substantially lower than 30-year yields going to 10%, things like that. People were really worried about what QE was going to do. And I turned around to my clients and said, QE actually cannot create inflation. And with all these deleveraging forces that we have in the economy and deflationary forces, you take advantage of what the markets give you. So you had to have the right view that we were not going to have a steep hiking cycle in particular. Anyone who understood this, whether it was the demographic angle or the deleveraging angle, they had an edge in, how they attacked the interest rate markets, in that they were buying dips and had a bullish bias in duration the entire cycle. But if you were a good, trade structurer, trading options, you could get trades that give you an edge when you had the steep forward curve. And so there were a variety of different trades that you could put on, but you had staying power to the point where even if you had a period where bond yields moved up 25, 30 bips, you probably didn't lose a lot of money if you structured it properly. Whereas if you were just buying futures or buying, 10-year notes, on those trades, you probably get stopped out. But if you structured them using the derivative markets, you had far better staying power for these, longer term themes or medium to longer term themes that were playing out that entire decade.
So we all know now that QE doesn't cause inflation, but I do remember that period. There was the famous, open letter to Ben Bernanke, and everyone was thinking that inflation was about to pick up. Why were you convinced that it wasn't going to cause runaway inflation?
It's because there's an asset and a liability that happens when the central bank does QE. And so when the central bank does QE, their asset is they're buying bonds. They're buying it from a bank, right? So let's just say a JP Morgan. And when they buy it, they deposit reserves that they issued out of thin air.
Right.
The issue is that reserve is not a permanent increase in reserves, or it wasn't meant to be. I mean, now, since they've never been able to really shrink their balance sheets, reserves are almost permanently higher. But the way it was designed was it was not going to be a permanent increase in reserves. So that's one thing. But the second thing is that what can banks do with those reserves? When you give them this excess reserves that are not tied to increased deposits in the other side of their balance sheet, well, it just means that it stays within the reserve banking system. So in the example I gave you where JP Morgan sold a bond to the Fed and now has more reserves, and maybe they don't need those reserves, maybe they're well above, their required reserve level and they have substantial excess reserves. Well, all they can do with them is lend them to another bank that does need them, to Bank of America or Citi or whatever. And so these reserve balances don't actually leave the Fed funds system, the Federal Reserve system. They just stay there. So it never actually hits the real economy. So now, what it does do is it compresses risk premiums. And so it forces investors to look at treasury yields and say they're lower than otherwise would be due to the forces of QE. As a result, I'm better served extending out to buy credit or even further to buy equities.
Right.
And they were trying to stimulate the economy through the wealth channel because they were at the zero lower bound and facing what's called the liquidity trap, which Japan famously faced for many, many, many years and is only now starting to break out of it. But because of the liquidity trap, they really couldn't cut rates any further. And the only way that they could stimulate the economy was through the wealth channel. But none of the forces of QE actually left the financial system into the real economy. And I figured this out quite early on. And I remember having debates with economists and strategists and everyone. And that was the missing link, I think, that, told me that this cannot create inflation. What it can do is create asset inflation, asset price inflation.
So I completely agree. And the analogy I always give is that, when Ben Bernanke bought $1 billion of bonds from JP Morgan, from Jamie Dimon. That doesn't actually make Jamie Dimon go out and lend out that money. And the reality is they were never reserve constrained. They were always balance sheet constrained, and there needed to be demand. I'm curious of how you figured that out, though, because it seems like you figured it out way ahead of most people. Like, was it seeing the plumbing? Like, was it having a front row seat to it and just realizing that, like, I saw this transaction, I realized that this wasn't going to go anywhere and was going to get stuck in the system? Like, I just love to know how you figured that out so quickly.
It goes back to my University of Chicago time, where I took central banking plumbing classes, specifically. And in those classes, they walk through the framework, the operational framework of what the central bank does. And, basically, what I always was under the impression was that the Fed set interest rates, and that's where interest rates were. But the way that they actually did it, at least at that time, was through open market operations to get the rate where they wanted it to be. And using things like reserves, balances, and all that. Obviously the framework has changed substantially since then. But it was eye-opening to me that you actually look at the Federal Reserve the same way you look at any company. It has a balance sheet with assets and liabilities to it. And you're spot on. And I recognize that the banks themselves, when they were getting flooded with reserves, their capital was not growing. And banks have capital ratios that dictate their leverage in terms of what they do, whether it's lending to the economy or securities portfolios. They have capital constraints. And so if their capital hasn't grown, they can't increase their lending, even if they're flooded with these reserves. So these reserves just became another form of cash that they could, earn a little bit of interest on once the Fed started paying interest on it. But it could not hit the real economy, and it couldn't, and for that reason, it couldn't create inflation. So that's how I figured it out.
So I think that's really interesting, because actually that's not the answer I expected, because there's no doubt that the conventional wisdom was not that, and I didn't expect you to have learned it at university. Why do you think so many people got it wrong?
It's not something that's intuitive to look into. And also, it's not something intuitive to look into is the central bank plumbing. And at the time, there really was no need to do it. There really wasn't any reason to think about the central bank's balance sheet. It just didn't matter at all in those days what the central bank's balance sheet was.
Yeah, because it was all scarce reserves, and it was all at the front, and it was very minimal.
Right.
Yeah.
And anything that they owned in securities was really T-bills. Yeah. And it was really just for the orderly functioning of markets. It wasn't to actually influence rates across the curve. But once they started down this road, the first question I had for the econ team at Credit Suisse was, these reserves are not permanent. So if they're not permanent, how can it actually, stimulate activity when, as a bank, that these reserves can get called back at a certain point in time? And that was the first angle that got me to start digging into it. And then I started, applying the lessons I learned from school to the plumbing of the system to get there. So it wasn't like a straightforward process, but it didn't take me long to figure this out. And, when I had clients buying, like I said, those 10% strike 30-year type of payers, I was very happy to sell them. That was fine by me. For our desk, we did quite well with those.
That's great. All right, so you're there. You mentioned the politics, and eventually you tap out and you go to another place, and you end up actually with Dean Kernut, who's Macro Risk Advisors, and he's got one of the most fantastic podcasts out there. Alpha Exchange. For anyone that's interested, go out and listen to it. It's terrific. Dean does a great job. He gets some great guests. How did you end up with him? Like, was he a client? Did you know him from the sell side? And what were you doing there?
I had a friend who was on the buy side who was covered by Dean and Dean's team. And, I connected with Dean, and it just so happened to be around the taper tantrum. So that's when I left Credit Suisse in the taper tantrum. So, rates was top of mind. And rates were impacting equities. And Dean is, he's someone who obviously his expertise and career focus has been primarily in equity options.
Right.
But he's always tried to look at the other asset classes as pieces of the puzzle to help understand things. And so he had an interest in saying, is there a way that we could build a rates and FX business a sales business to complement what he did on the equity options. And so that's what I joined to do. It was a little tricky regulatory wise to get, it's a little bit different when you're talking about the interest rate markets versus the equity markets, especially at that time. The broker dealer versus agent is a little bit, that is a little bit more complicated. And so we ran into some problems in building the business.
Okay.
But, overall, it was a great experience to work with Dean. I'm a big fan, and we still talk, regularly.
So from there, you move on to another hedge fund and eventually your own. Just kind of give us the 2 lines about that period of your life.
Sure. So I don't know if you're familiar with Mike Green, Professor Plum on Twitter.
Yeah, for sure.
He was a client of mine for 4 years. We had a good rapport. I had, worked with him and designed strategies that were very good fits for him when he was at Canyon Partners. And, he decided to launch his own fund, and he took me out for dinner once and said, instead of designing strategies for everyone else, why don't you come join me? And, we were talking, and, he was saying, what I'm going to do is you'll be the interest rate guy and I'll get someone to be equity and FX. I was like, listen, I actually know those markets too. It's just that they weren't my focus at, Credit Suisse when I dealt with you. And in the end, I joined him at launch and was able to, be head of trading and risk and kind of a junior or co-portfolio manager working with him to design the strategies and execute them and manage the risk of them. It was really terrific experience because I was able to broaden my experience set out to different asset classes and, have in my toolkit the ability to look at almost any type of trade. He had an appetite for, simple strategies as well as complex strategies. So I was really able to spread my wings and do that there. So it was a great time. We did quite well, for the macro environment in this period. Macro was struggling, probably because they were continuously betting on higher rates, if I remember correctly, and constantly being frustrated by that. We were the other way. And so, we outperformed the macro community by about 8% a year over the 2 years that Ice Farm was in business, while I was there. But fundraising was difficult. And I know Mike, struggled to get it to the scale he wanted to. And so unfortunately he decided, to move on. And when that happened, I had never even contemplated launching my own fund. But what was eye-opening to me was, here was an experience at Ice Farm where our trading was really strong. And I thought, when your trading is really strong, capital flows in. And I realized that there's a business side of things, and the business side is entirely different. And your expertise as a trader, portfolio manager, may not blend over into the expertise to manage the business side of things. And, I decided to build a very different type of hedge fund. So, essentially what I tried to do was say, I think the 2 and 20 model is flawed. There's nothing scientific about it. There's nothing that, says that, this structure is what's in the best interest for investors. It kind of just got created in the 70s and 80s and is persisted to this day. And, I tried to build a fund that had very different features. We had no management fee. We had, we took our capital structure, which is normally in a hedge fund, you think of a commingled, pool of capital where all investors are in one pie. I created a capital structure to that pool of capital where you had 2 sides of the structure. And by slicing and dicing the risk and return profiles, I actually created 2 unique payouts for investors. So it was this really big vision I had to create something different, which was a tremendous opportunity to try to do. Unfortunately, when I was running it, I felt over the course of 2022 that the structure itself was just too complicated. And even though I thought it had a lot of potential, first of all, it was designed before COVID hit and the world had changed and the markets had changed.
Right.
And so one of the payouts, one of the sides of my payout structure was a fixed income product. You had the safety of a government bond, but the yield potential was higher than what was available in government bonds at the time. So it was essentially a fixed income product that would appeal to institutional investors, pensions, endowments. But, when you hit 2022 and rates are substantially higher now, all of a sudden I'm competing with T-bills. And that was not a competition I felt like I could win. And then secondly, the structure just was dictating my risk taking more than the opportunity set in the markets. And so when I got to that realization, it was a sign that this is not how I want to trade. This is not what I want to do. And also just I was way overworked doing this, so I decided to.
So now you write a letter.
So now, last year I joined Twitter after staying away from it for a very long time on purpose.
Yeah,
I joined last year right around SVB time, and I actually was pleasantly surprised hearing or seeing a lot of very valuable views from different people, and I was able to provide my voice into some of the debates that were going on. Are we going to an imminent recession? Are we going to have all these rate cuts that are priced in and all that? And I started to, I guess, build a little bit of a rapport doing so. I didn't really target that as an objective for me, but started to do that. And then earlier this year, I said, if I'm going to be providing people my views, which I've never done in my career, publicly, I'm better in a long format, a long form format where I can write. You can't really describe things like demographics in a tweet thread. You have to really, dig into those topics, or term premiums and topics like that. So started putting those together, and so far so good.
All right, so let's get to the markets. One of the things that you did after the November pivot, you had a big call. You said there was going to be no rate cuts. And that was actually quite a call, because back then there were 6 rate cuts priced in. I'd love to just kind of go through what you were thinking there and whether that view has changed recently.
Okay, so as far back as 2022, I studying the markets, I recognized that we had a financial conditions loop where we would get, these tightening episodes where rates were moving higher, the dollar was strengthening. Obviously, equities were suffering during 2022. But then we would get these relief rallies that were quite substantial. And, bond yields moved lower, dollar would soften, and equities would relief rally. And, I recognized that actually these financial conditions loosening periods were resulting in reaccelerations in the economy. And so we started to see that. And so at the end of 2022, when people were looking at the beginning of 23 and making their forecasts, everyone out there was saying, we're either going to have an imminent recession, or we're going to have really, really slow, meager growth, and inflation just gets to 2%. And I had the complete opposite view, which was, over October, November, December of 2022, we had a substantial easing in financial conditions, and this result would result in a reacceleration in the economy. And that's exactly what happened to start 2023. We had 2 months of huge payroll gains of, I think, 500 something K and then 300 something K. Big surprises as the economy started reaccelerating. But for people who were paying attention, it was visible in some of the more cyclical data before then, in that as soon as rates came down, housing recovered. And I noticed that housing had started to recover. And then you started to see other aspects of the economy recover. You started to see consumer confidence recover. So it was actually fairly predictable. And we ended up obviously getting SVB happen.
So that's Silicon, for those who don't know, that's Silicon Valley Bank, and
Silicon Valley Bank goes under, and
bought way too many bonds at 1%. Like idiots.
And I mean the acute nature of it was quite scary. People had PTSD around 2008 bank failures and things of that nature, and so everyone started to think, there's an imminent recession. They're going to turn around, cut rates. The story's over. But the Fed, clipped the tail. They clipped the tail of what was the worst of SVB, which was it started out as a liquidity crisis in that deposits were fleeing the system and banks had no way to replace them. And, that was clipped as soon as they created that BTFP facility where banks could access as much liquidity as they needed for their security portfolios. It's just that it came at a cost. And so it went from a liquidity crisis to a solvency issue. And solvency issues like that, when you're talking about funding has just increased in cost for banks, is a very slow moving story. And so when we had, at that period, we had 150 bips of cuts priced by the end of the year. despite the fact that what looked to me like the worst was past. And so I knew that, I made a call then as well. We are going to have another reacceleration in the economy.
Okay.
And lo and behold, we did. We got an 8% nominal GDP quarter in Q3. And along the way, as the economy started reaccelerating, we started to have what I've termed the term premium tantrum, the back end of the curve starting to go ballistic, and without any influence from the Fed. That we weren't pricing additional rate hikes at that time. The Fed was happy to sit on their hands. So lo and behold, when we came into the end of 2023, we saw the exact same story. In this case, we had something like 130 bip move lower in 10-year yields. We had equities starting to rip. We had the dollar soften. Oil came down, even though oil is not considered part of financial conditions. It is something that affects the consumer. And so all of these things were supportive of the economy reaccelerating again. And so in November, I said by January, the economy is going to start reaccelerating. And as a result, they won't be able to cut. And so, that was coupled also with a view, which has been a long-term view, that inflation would be sticky at higher levels than what the nice little 3-month moving averages were pointing to at the end of the year.
Okay, so we're going to get to that. I have a question for you before we go there, and we kind of keep going. I've heard you say a couple of times the economy was stronger than the market, than people expected, and it bounced. Do you have a theory as to why it is continually surprised to the upside and the high rates haven't dug in as much as everyone expected them to?
There's two stories here. There's one, the cyclical story, which is the one that everyone's familiar with, which is the health of household balance sheets, the health of corporate balance sheets, where everyone termed out their debt, but also, they had all the deleveraging that needed to happen from the GFC had already happened. And now both of these agents in the economy were now relevering, and they were able to lock in that leverage and lock that in for many, many years to come, in some cases for 30 years in the household sector. So that's the story that everyone knows, which makes the economy somewhat more resilient to the transmission of interest rate increases into the economy.
Okay.
That's one. The second is demographics. And this is the story that people are still confused about. And this is, in my opinion, maybe the more important story. Because what I'm saying with demographics is the structural nature of the economy has simply changed. And it's changed in ways that are profoundly different than the economy was from 2010 to 2019. And it's almost as if it's two completely different economies.
Okay.
But if you're anchoring your bias to what happened then, you're going to think rates can't be high enough, can't be at these levels without crushing the economy.
Right. So what's happened to demographics that's changed that? Okay.
So if we go back to the prior decade, you had baby boomers, which are the wealthiest, part of the labor force, in their last 10 years to retirement. And on top of it, they had just gone through two crises with their retirement savings. One was the dot-com bubble.
Yeah.
And the other was 2008. Both were pretty devastating to their retirement portfolios. So the baby boomers with 10 years left to retirement anyways would have a very high savings rate. But because of the hit to their balance sheets, they actually had even higher saving rates than demographic models would have implied because of that weakness in their balance sheets. And so when you had a situation where savings were really high at a time with all these other deleveraging forces that we talked about earlier, this causes inflation to be lower than otherwise would be. It was a disinflationary force and is also supportive of the demand for fixed income.
Okay.
Whereas when you came to this period, as far back as 2018, the demographic models all said that by 2023, baby boomers would start retiring en masse. Well, obviously, it happened a lot earlier when COVID hit. Some people just made so much money in the markets. Some people were afraid of the virus, and people retired earlier than anyone expected. And so what is the implications of that, that change in the demographic situation? It means you took the biggest savers of the economy and moved them into a dissaver role, right? Because in retirement, you have your nest egg and you slowly spend that down every year.
Right.
You
Okay.
still consume, but you're no longer a saver. So aggregate savings for the economy have gone lower just simply as a result of baby boomers retiring.
I'm with you.
Secondly, when you're in your 60s, it's just the nature of it is it's not the most productive decade of your working life. You're more productive when you're in your 40s, where you have a little bit of experience, but you're also, still have, a substantial motivation to expand your career. In your 60s, you're mostly comfortable with your career. I mean, I'm generalizing here. It doesn't apply to everyone.
Right.
There are people, my father, in his 70s works extremely hard. So it's not the case, but it is the case in aggregate. This is how it tends to work. So you actually took the least productive segment of the labor force and moved them out of the economy entirely. And then you took the next biggest labor force group, the now biggest, which is millennials, and you moved them into peak productivity in their late 30s, early 40s. You move them in also into peak family formation phase.
Okay.
So now they're at the point where they're looking to form families. They're looking to buy a house in the suburbs. They're looking for the, picket fence. They're looking at, schools out there. They're, starting to have children, things of that nature. So we've had a substantial increase in demand for durable goods, housing, and things of that nature. We've had a substantial increase in productivity just due to the changes I mentioned. And we've had a substantial decrease in aggregate savings. So all of these lead to a higher R star, so to speak, or a higher neutral rate than what we had in the past. Also, when we don't have all those deleveraging forces that we had talked about. So all told, these changes are pretty large. And I can tell you, going back to the last cycle, I was focused on demographics with Mike Green. Mike Green was a mentor for me in demographics. We were focused on them, at 2014. And it really took until 2016 for this to become a mainstream consensus. Central banks started talking about it. Economists would talk about it. People on CNBC would talk about it. And at that point, it was well understood. But for a few years, it wasn't. And I think it's the same story here, where at some point in 2024, the Fed is going to start to realize the demographic changes lead to a structurally higher R star. And I think that's why we're having debates on, neutral rates and how resilient the economy is and things of that nature. This is the missing link that people haven't really figured out yet.
I like it. Okay, so you mentioned the Federal Reserve, and in their summary of economic projections, you can actually see what they think about the R star and the long rate neutral, and it's just starting to tick up, like ever so slightly, right? One of the things that I think is going to be interesting is as it ticks up, do you think that could cause a repricing at the long end of the bond market?
Exactly.
Do you think that they're reflective of here, let me back up a little bit. One of the things that I think is that the Federal Reserve, that those economists, they represent consensus amongst portfolio managers, especially bond managers. I think that if you go and poll big money, they're not that much different than what those Federal Reserve thinks. Everyone is still thinking that our star is lower. Yeah. And one of the things that I'm kind of was going to ask you next about is, people are saying, oh, the bond market's in trouble. The bond market's trading so badly. And I'm always like, listen, term premium is actually pretty well behaved. The curve's inverted. If the bond market was in trouble, we would have bonds at 6-7%. It doesn't make any sense. So one of the things that I'd like to ask you is, do you think that this realization of R star being higher is actually going to be an event that causes a backup in the long end of the bond market? And then if so, do you think that translates into problems in the rest of the market?
So there's two big implications. One is that if the neutral rate is higher, they're not as restrictive as they think they are when they say, Fed funds minus minus their neutral rate estimate of 2.6.
Right.
So they think we're almost 3% real rates on that metric. But I think the neutral rate is probably around 4.25% to 4.5%.
Oh, wow. You're higher than anyone at the Fed.
Oh, yeah.
Yeah, okay.
And on top of it, that's assuming a steady state of 2% inflation. If we have a steady state now of 3% inflation, you actually get to 5.25% to 5.5% for the neutral rate right now. And so, maybe that's not the forever neutral rate, but that's the neutral rate for this economy. And if that's the case, then they're just at neutral with the Fed funds rate. But what I think they're missing is that the Fed funds rate is the least impactful rate in the economy. It's the 10-year rate that drives car loans. It's the 10-year rate that drives mortgages. And so the reason I think the curve is as inverted as it is the markets have been for 15 years conditioned to worship at the Fed's altar. Right. We listen to every word they say. We gravitate to their forecasts. We're obsessed with what they're thinking, whereas we used to be obsessed with what the economic data would tell us and figure it out ourselves. But now we're obsessed with their reaction function, their thinking. And you have to go back to what caused this curve inversion to begin with. Well, they smashed and compressed the term premium in 2021 when 10-year yields were 1.5%, and they were buying, between them, their reinvestments, and the banks, call it circa $300 billion a month. And they were buying despite the economy being, 13% or whatever nominal GDP at the time. So they absolutely destroyed the term premium and flattened the curve way more than what should have happened when the economy was reaccelerating the way it was.
Okay.
So there's that. But then two, their dot plot, not only the long-term neutral rate, but even as they were hiking rates, they were saying, but we'll turn around in 24 and cut. And we'll turn around in 25 and cut. They were hiking 75 bips a clip, but still forecasting cuts.
Well, because everyone thought the economy was going to roll over and couldn't handle those rate hikes.
Exactly. Yeah. But the Fed made a mistake in messaging that. And it's been one of their biggest things is in messaging that. And so why I was so critical of their pivot in November, December was, all they were trying to do is actually reasonable. It's, there's a lot of people who think there's conspiracy theories. They're trying to goose the economy for the election. No, what they were trying to do is tell us their reaction function. If we get, 1.2% real GDP and unemployment of 4.1, 4.2, and inflation continues to moderate, we will then cut 3 times.
Right.
That was what they were trying to do. But the problem is when you give that message, the markets run with it. And then when it runs with it, then it goes away from you. And that's exactly what's happened. So their best option was actually October 31st was their optimal policy set. October 31st, you had every part of the bond curve over 5%. You had core inflation around 3.9 or so, and core CPI. And you were restrictive. I don't know how restrictive, per se, but I do believe that if they'd stayed there for a material amount of time, it would have, softened the economy. The problem is they pushed back on it. Yellen pushed back on it with her issuance schedule. So they both pushed back on it. And then they obviously telegraphed cuts and made it even worse. But that messaging side of things is where I think they screwed up. So yeah, to get to your question, I do think the back end of the curve has to go higher. That's the solution that's needed. The problem is the Fed, from all their speeches and all their, everything that they've discussed with the markets, I don't think they really understand that how much more important the 10-year yield is to their objectives than the Fed funds is. They never talk about it. So I don't know that they'll, figure that out.
Clue into that. A few things there. I actually completely agree with you about the dots. I think they're the stupidest thing in the world. They should just take it out. They shouldn't be doing any of it. People confuse it because it's not even a group message in that they do them independently. So it ends up being very, very, very kind of nuanced different things. And it doesn't take much to switch it. But one of the things that I think that you might agree with me on, and you mentioned about them doing QE even as the economy was taking off, I've always kind of been perplexed about how they can use QE as a policy tool to stimulate the economy. and then they refuse to use QT as a policy tool to slow it down.
This is exactly, you're preaching to the choir. When we first heard QT, the equity markets went ballistic, right? In the reaction to it in early 2022, when it was in the minutes, because I think people anticipated that they would be doing active sales, but they weren't doing active sales. They were just letting T-bills roll off their balance sheet, which doesn't really affect anything, right? So I think this has been their biggest policy, snafu, is not using more QT. If they had used more QT, actual asset sales, selling the long end of the curve, off their balance sheet, they may have been able to stop at something like a 4.5% policy rate without getting it as high.
I completely agree. Not only that, you also might have avoided the SVB because the reality is those guys were like, oh, the Fed's buying it, everything's okay. So instead of doing 50s and 75s, I would have been doing 25s and then pasting them with $500 billion a month. The curve would have been normalized. You would have had a long end being proper. Like, it would have made so much more sense. And I'm just flabbergasted that more people don't talk about this, and nobody kind of at the Fed ever even considers this.
And then when we've seen the financial conditions episodes, the easing episodes, and how they work counter to their objectives, every single time, it's all because 10-year yields move lower, which causes risk appetite to pick up, and it causes other parts of the economy to respond accordingly. Instead of having, in Japan, they had yield curve control, right, where they were saying, yields are capped. The Fed should have had yield curve floor. Okay, this has never been in consideration. But if they don't want to do all the time sales from the balance sheet, well, maybe you should say, if yields get too low, we'll sell. But then when we're at 5% 10s, we don't need to sell. And so you actually would have had an automatically adjusting policy stance that I think would have been better. But there's a reason I don't work at the Fed.
Teddy, you're a genius. I love that. I think that's a great idea. And I've always said that even about the GFC. They were doing QE at a point when everyone was buying, bonds. I was like, everyone wants bonds, like, is trying to buy them. Why are you guys, just piling on and also buying bonds? In fact, the Treasury should be selling those bonds and actually spending the money. But, that's the story for another day. Okay, so let's talk about how this plays out. You've highlighted how you think that inflation is going to be stickier. And I think we've seen that with the last three inflation numbers have come in higher than expected. I suspect you believe that is the demographics at work. Do we have a UK style gilt sell-off that causes a real problem sometime in the future ahead of us?
I think we are starting to see the bond market get very jittery. I don't think it'll be as bad as, the UK situation, unless, listen, if Biden came out and to improve his election chances, did another trillion sort of, proposal, which wouldn't get through. It would have to get through Congress, which I don't think would. But if he did something like that at this stage, I do think we'd get there. So what I think more likely is, we are getting a little bit of financial conditions tightening now in the last 2 weeks. I don't know how sustainable it is. If we get enough of that, where it persists for a number of months, then they may not need to hike rates. But I do think that ultimately, because they can't control that, and because they don't even know that they need to control it, that whatever tightening we get will probably unwind at some point. And when it unwinds, then we're just in that same loop. So I think what we've been seeing from the Fed is actually they've lost control of financial conditions. And so they lost control because, when they did that pivot and then the economy started to perform better than expected, they've started to push back on cuts, right? And so first, that we had 7 or 8 cuts, which was ridiculous. They started to push back on those, started to push back on the timing of them. And we've removed a substantial amount of cuts, since then. And it really hasn't tightened financial conditions much at all, other than the last 2 weeks. And even then, it's quite minor. The S&P is only down, 3 and a change %. So, it hasn't really impacted the economy, and it hasn't impacted financial conditions. So the only way that they'll actually be able to regain financial control of financial conditions to soften the economy will be to at least threaten hikes. So at a minimum, I think when it comes to the June FOMC, the June meeting, when they have their next projections, I think that's the most important meeting since Jackson Hole 2022.
Really?
And I think the Fed, because the Fed has a very risky situation ahead of them in that inflation is sticky, the economy is very strong. They misjudged both of these. Fine. But the risk of a second wave is very high at this stage.
Second wave of inflation?
Yes.
Okay.
I don't think we have the conditions for it now. But as we saw last night with, the scare in the markets over an attack on Iran, there's still geopolitical risk out there that could lead to another supply shock. If we got a supply shock 2022 style where, let's just say 2 million barrels of Iran's oil are taken off the market or something of that nature.
Okay.
Well, we could have a shift up in inflation away from like the 3.5% range I think we're at, but to more like 5%. And that would be pretty bad. The other way it could happen is, and this is really hard to predict, is if lending picks up. And the more the economy doesn't contract, the more the economy remains strong. At some point, banks have to say, why aren't we increasing lending? Like, we should be making money here. Like, we want to make money. The household sector in aggregate is pretty healthy. The corporate sector in aggregate is pretty healthy. There's pockets where they aren't, but in general, they are. And so, if lending picks up, then we have a second wave. And so the Fed has to get control of financial conditions somehow, because in my eyes, there's no chance they hike rates before the election. So from June to December, they have handcuffs on. And they have to be thinking about the situation where in that 6-month period, things can run away from them again. And if they run away from them again and they're not free to act, their verbal messaging has not done anything to tighten conditions. So their speeches and their comments and all that won't do anything unless they are at least symmetrical. And basically what I mean by that is we're equally likely to cut or hike as the next move. So we went from neutral to dovish hold, meaning like our next move is expected to be a cut, to very dovish. We expect to cut, imminently, back to dovish hold, and now they have to go back to neutral. And in that neutral stance, maybe they get lucky that financial conditions tighten enough that they don't need to hike again. But otherwise, I think if they come to December and we still have a 3.5, type of core CPI, which based on base effects, I think is very likely, then they're going to have no choice but to hike. So that's why I think they will ultimately hike.
So your scare is your nightmare scenario is we get a situation where the economy picks up for a variety of different factors, inflation stays sticky, and we get a situation where the Federal Reserve won't hike in what's needed, and that actually causes the long end to sell off even more. Am I correct that you would assume that?
If they are able to correctly message that there's no cuts on the horizon, I think the back end of the curve will move higher without the front end moving higher. So we get the proverbial bear steepener,
right,
that we got in Q3 of last year. And maybe that does the job if it persists.
Oh, so you're saying they almost would want that.
They need that. They actually need that.
Okay.
I don't know if they recognize they need that, but they need it. And so if they're able to thread this really thin line and get this to play out the way we just described, they won't need to hike again. But in the event that they get to December and it hasn't played out that way, like either the 10-year touches 5 and then goes back to 4.25, and like we play this game all over again, then they will not have sufficiently tightened financial conditions. And we get to the end of the year, I think their comfort level with CPI, with inflation being above target, is going to get really uncomfortable at a certain stage. They say they're comfortable with it being a slow process now. But if you get to December, that's 4 full years. 4 full years of well above target inflation, like almost double target inflation. And what happens is the longer you allow this to play out, the more it becomes embedded in psychology. And this is difficult for, to study in economics because we can't really measure it. But, if you go back to the last cycle, companies were always wary to raise prices because they knew they would lose market share. So they didn't do it. But now companies are actually looking at this a little differently. They know they'll lose some volume sales if they raise prices, but the combination of a little bit of lost volume with higher prices may actually, in some cases, lead to higher revenue. So they're more comfortable making that change, and that stigma is gone for them, so to speak. And the household sector clearly is not shy to turn around and say, I want higher wages.
Right.
We saw the ADP report 2 weeks ago, the job switcher numbers, that was 10% year over year. You look at the Atlanta Fed, job switcher versus job stayer, substantially higher. So there's no stigma around unions turning around and saying we want 10% year over year wages. The stigma's gone. And so you really risk by the end of the year that this is embedded in psychology and that the only way to get rid of it is actually a deep recession. The longer they wait, the deeper the recession will need to be. And so that's why I don't think they'll be so comfortable if we persist at these higher levels by December. And I actually think we're starting to see their reaction function already change. It just hasn't really tightened anything substantially yet. So that's where I'm a little skeptical that they'll be able to do it without hiking.
Okay, I think that's a great explanation. Now let's go on to equities. Well, one of the things is that I think that you're a little bit of a bond bear. You think rates are going to, be higher. So far, the equity risk premium is not done what you'd think it would be done. It's cheapened, and we're in the tightest spot that we've been in for a long time. Does eventually the higher rates result in a lower PE for stocks? And what will be the catalyst to cause that?
We're starting to see that, but I think it's not just about rates. It's also about the fact that there's a lot of other risks. Geopolitical risk as well is pretty substantial. The fact is that you also have, equities ran the way they did because they anticipated a serious growth reacceleration. But now we're at earnings season, and now we need to see that corroborated by earnings. And so I think part of it is also that, as earnings revisions have started to come a little bit lower, kind of realization that companies are not matching, the earnings with their price gains that have gone on for the last few months. And so I think it's a combination of all these factors. So I was actually very bullish as soon as, November started. And then that December FOMC was like my max bullish. As much as I can be bullish, I was max bullish as soon as they were what I call irresponsibly dovish. And, we just kept running, nonstop this market. Animal spirits were out. But at the end of March, I started to get uncomfortable because I was talking with a number of, PMs and risk takers. Nobody could make a bear case for me. And that really spooked me. And then I was seeing on every single day, triple X, SMCI or 3X, NVIDIA. And like these, what I started to realize is the leverage that's usually, in terms of margin has moved to these other products. And so I started to get a little uncomfortable with the equity market then. And then since April, I've been, just bearish and selling rallies.
Yeah.
But that being said, I think there is a place where it's really about how fast rates move up, less so than the specific level. Because if I'm right that the neutral rate is higher, then, theoretically, equities are going to have to learn to live with higher rates. And the fact is, when you look at the corporate sector, forget about equity markets, but if you look at the corporate sector, they're really not bothered by interest rates at all.
Yeah.
IG all-in spreads, all-in yields, if you include spreads plus treasury yields, they're lower than the Fed funds rate for the first time ever in history. Corporate net interest payments have fallen off a cliff because they can earn money on their cash, which they never could before in the last 15 years. And on top of it, they've termed out their debt. And at the start of this year, companies took huge advantage of lower rates that we came into the year with to take care of some of their refinancings. So I think the corporate sector can learn to live with higher rates. And I think the equity markets will ultimately learn to live with higher rates. It's the speed of it. If we are going to fly to 5 or 5.5 in a really rapid period of time, and we have been selling off in the bond market in a rapid pace, well, equities are never going to digest that. But look, we have an 80 bip higher 10-year yield than where we started the year, and equities are down 3%. It's like, it's not what you would have expected, right? This is definitely not 2022. So I'm bearish for now, but it's not that I think there's a catastrophe ahead in the equity market. And and if the equity market doesn't have a material sell-off, 15, 20 plus percent, that actually sticks, then it's unlikely we get, the sufficiently tightened financial conditions. And and that's why I think, they're going to have to turn around and hike again.
Right.
That's the only way they'll be able to accomplish it.
Got it. All right. I could go on like this forever, but we got to talk about Canada a little bit. One of the things is that a lot of the terming out of debt and the balance sheets of the consumer and the corporates that are in such great shape in the U.S., it's different in Canada. And I suspect that you and I are going to share same view on that. And it's not going to be just because we're both from here. What do you think about Canada?
I'm probably most bearish on Canada than any economy in the world.
I'm with you.
That's saying something because I've had a consistent bearish view on Europe, and Canada has surpassed them. And the reason I'm really concerned is there's debt in all three, sectors of the economy is substantially elevated. So if you went back to 2008 in the US, you had a scary household debt situation. You obviously had, but the financials, the banking sector had also a substantial amount of leverage. But corporates, except for financials, excluding financials, really didn't have a lot of leverage. And the government didn't have a lot of leverage. So when the household sector had to delever, other parts of the economy picked up the slack. In Canada, all three areas, government, corporate sector, and household sector, have enormous amount of debt. Canada was one of the healthiest countries in debt to GDP coming into COVID. They're no longer there. They're not the worst, but they're just as bad as everyone else now. The household sector, it is far more perilous than what the US ever had going into 2008. Now, we don't have like subprime loans and packaging loans into like CDO squareds and all that crap, but we have a very scary situation where more and more and more income is simply going towards servicing debt. And so, you've been in the markets a long time and you've been in the bond market a long time. There's only two ways to get out of these high debt levels. One is inflation or default. And there's no appetite for either of the two. The Bank of Canada is actually probably the most hawkish central bank out there in that they have every reason to cut, but they've been holding off because they're trying to squeeze that last mile of inflation. And so there's no sense that the Bank of Canada is going to accommodate the debt situation with higher inflation to inflate this debt away.
Isn't he going to have to, though? Like, isn't he kind of he's just hoping right now, but like in the moment that our economy rolls over, he's going to have to cut down to zero. Like, isn't our dollar headed down 20 cents?
I think they will ultimately have to cut much more than other economies. The issue is going to be threading that needle where if they cut a little bit in a sort of soft landing adjustment pace, like what people are hoping for, that the housing market actually might rebound. And if that happens, then you end up with a situation where you can't really cut too much. But, that's what's the challenge here. The challenge is the central bank, is really not indicating that they're willing to tolerate higher inflation at all. So they value their independence on that front. And the Bank of Canada has been warning about the housing market for well over a decade. And then on top of it, you look at the other agents in the economy, and none of them have shown any appetite to delever, on their own. And, Canada is, as it socializes losses, right? So the likelihood of this like wide scale default cycle that actually cleans us out of this risk. The U.S. had a nasty deleveraging, but that's why we have such a strong economy today. And Canada needs to go through this. So we're left with a series of bad outcomes, and the most likely outcome is going to be just really meager, languishing growth for a very long time. So I do think dollar CAD is probably going to go to 145, something like that. I'm probably going to put a trade on a more structural trade, bearish the Canadian dollar. I like receiving their rates relative to the US. And here's why it's complicated is that, we've had pretty bad data in Canada the last 3 months. The
our CPI keeps coming in light. The US is hot and ours is light.
It's light. It's like 2.6 core inflation or 2.8 core inflation. It's really right in the range that they want it to be. And by the way, the only thing that's kept it as high as it is housing,
right? Which
has been led by the immigration policies of Prime Minister Trudeau. So if you didn't have that, inflation would be 1%. Yeah. So they would have already been cutting. But the problem is, if you look at their yields, they've gone up 80 bips. Let's just say Z5, bankers acceptance Z5.
Oh, it's Cora now. You're supposed to be trading Cora. No more bankers acceptance.
That's true. It's actually going to switch to Cora. But, those rates in December of 25, they've gone up 80 bips in the last 3 months. So that means the economy will worsen even more than it should, because they have a justification to cut, but rates are actually moving higher. And so they actually need to cut even more to compensate for the fact that Canadian rates just have a beta to US rates. I think the cutting cycles for some of these other economies is far more complicated than people want to really, imagine. So UK, Europe, Canada, these economies that want to cut, it's much more complicated, for all these different reasons. Yep. And so that's why I'm very pessimistic on Canada. And it just does not seem like anyone in any chamber of the government really recognizes the situation and how bad it is, because the federal government came out and just did another expansive budget just this week.
Yeah.
And it's been widely criticized. But they've done another expansive budget, and to fund for it, to pay for it, they're increasing capital gains rates to the highest in all of G7 for business, for entrepreneurs. And so when you do that, you're just disincentivizing investment and just making more and more of your economy focused on debt servicing. It's a really bad situation, and like I said, I don't think anyone really realizes how bad it is. Because GDP hasn't turned negative yet, people don't realize how bad it is. But I think they're looking at, a lost decade, if not longer.
I think your UST CAD is too low.
I think there's really two ways you play this. One is, I don't think the equity market is the way to play this, because they're heavily resources based equity market, and commodities are doing well. So it's not, I wouldn't be representative of the economy if you short the equity market. So really you're left with either the relative interest rates versus the US, or the currency has to weaken. And I'm betting on the currency because I'm doing both actually, but I think the currency is probably the transmission mechanism here, because it has looked like it's popped higher and is consolidating a little bit. So, I do think there's another leg to it coming.
I think we're going to hit all-time lows before it's done, like all-time highs in USD CAD.
It very well could. I don't even know what the all-time high is.
Yeah, it's 160 or something. It's yeah.
Oh my God.
Anyways, I think we're both on the same page. All right. Danny, I could do this all day with you. I love chatting with you. As I said earlier when we started, I said the problem is I think I'm going to agree with too many of your things you said. We're at the point where we're going to ask you the 3 questions that we end with. The first of all is, what do you think is the hardest thing to do in trading or investing?
So for me, the hardest thing is I'll have these longer term views, and you have to navigate the trading around them, right? So my demographic views, I've had, since the cycle started, the yields would be higher. but you can't just be short bonds for 4 years straight, right? You have to trade. And if there's periods where you have these relief rallies and things like that. So to me, I've always had to focus very firmly on improving at the part where, I have a very big picture, long-term view, but you still have to trade it in the, short term, so to speak. It doesn't mean that you need to trade the other direction when the relief rally happens, but maybe you sit it out and wait for your opportunity to go back with your high conviction view again.
Got it.
I think that's always been something a little bit more challenging to navigate, is the structural with, tactical aspect of my strategy.
All right. Don Cox, another famous Canadian, used to say that you shouldn't invest on what is on page 1 today, but what is on page 16 on the way to page 1 tomorrow. Do you have any trades or ideas that would get the Don Cox seal of approval?
Oh boy. Mine is a scary one.
Okay.
I think, as we saw with all of the geopolitical dynamics that we've had in the last few years, you need to take people's word when they say something is important to them. So Russia was, Putin was telling us Ukraine was important, and obviously then he invaded. Hamas is a terrorist organization, has been telling us for years that they want to murder Israelis and Jews, and they did it. And President Xi in China has been saying for years that Taiwan is a priority. And so, the issue is, how do you time something that is unknowable, unpredictable, something like them potentially making a move on Taiwan? The reason I bring this up is I'm very scared about the circumstances we have for the next 6 months, where they could view it as an advantage to go when Biden's in office and when the White House is distracted with the 2 other wars, and where, some of the stockpiles of ammunition and things like that have been depleted, right, helping these proxy wars. And on top of it, they could move to Taiwan in an hour. We would have a harder time being ready there, right? With Ukraine, when Russia made a move, the United States is supporting Ukraine by shipping them weapons and logistics and things like that. But with Taiwan, they'd have to be physically involved, right? So they'd have to move carrier ships to the region, which they're in the area, but it would still take them a day to get there. China would be there earlier. And then on top of it, when you were looking at Russia mobilizing 150,000 troops on Ukraine's border, we could see it coming. China could mobilize 10 million soldiers, and we may not even notice that on satellite feeds because they have a huge population. Right. So what I'm getting at is it's impossible to prepare for this. And what I would want to trade to have is in my book, because as we saw last night, and something militarily happens around the world, something's going to hurt your portfolio. You don't know what it is. There are going to be weird actions that you could prepare as much as you want, and something's going to affect you. I think dollar Taiwan deep out of the money calls is just something that people should have on. If you're an institutional trader, you can put this on. As a retail, you can't. But as an institutional trader, I think this is something you put in your book and you leave it there. And you may be very, very thankful one day that that you had them on. Like 1 year dollar Taiwan out of the money calls is actually something you can carry well because the forward curve is inverted, meaning the Taiwan dollar is strong in the future in the forward space rather than stronger than spot in the forward space. So it actually carries these reasonably okay. But if anything happened there, which is still a very, very low probability outcome, I think that currency gets a 10 to 20% decline in one day. And I think whatever we saw in equities last night with Israel shooting 3 drones at Iran is nothing compared to what we would see if Taiwan happened.
I like the trade.
It's a scary scenario, but I think it's one that it for whatever reason I can't seem to put this one to bed and walk away from it. Sometimes you have these longer term views and they don't materialize after a certain period of time, and you're like, okay, I think we can move on from it. For this one, I just don't think I can move on from it. I think it's unfortunately realistic scenario that they make a move. It's just impossible to know when and how.
I like the fact that you're incorporating into a portfolio and you're saying that this is a form of insurance you can have, and it's actually might be cheaper than buying S&Ps or, gold or something. This is actually something that might be a better way to hedge the portfolio. All right. The third and final question. Patrick O'Shaughnessy often asks his guests, what is the kindest thing someone has done for you to help you along with your career? This is such a great question. I'm going to take it from and borrow it from Patrick. Do you have any particular person or event that stands out for you?
It's less what he did specifically for me and just who he is and his framework, but I worked with Harley Bassman at Credit Suisse.
Yeah, we've had him on the show a couple times. Terrific guy. Isn't he a great human?
He really is. Convexity maven. So on top of being really smart and good at what he does, he's also a good guy. And he was someone, he was like a prop trader, which, we weren't supposed to have prop traders, but he was kind of a prop trader. And he, would talk to clients, and he came up with a way to express these like longer term views in markets. And so, like, similar to what I just described with Taiwan, when you have these longer term views, you just don't know the timing of them. The hardest part is to have staying power, right? Because if you're going to buy weekly dollar Taiwan calls, you're going to be spending a lot of money before you ultimately make money, right? On this scenario. Well, hopefully you never make money on it. But the framework that Harley always looked at is he had these high conviction, long-term views, and he had ways to express them in the option markets or structured trades that gave him staying power, where you might be long vol but still have positive carry. How he constructed it using the forward curve or the volatility surface or things of that nature. And so that was something that I really didn't have in my toolkit that has become a decent part of my toolkit in expressing longer term views because of what I learned from him. So that was really, really influential for me. And so I would choose him.
It actually makes me so happy for you to choose him, because like he's actually been very kind when I wanted to understand something. Like when he came up with his P-Fix, I phoned him up and he took time out of his day to explain it all to me. And he seems great. And, it's great to see someone that's successful and then humble and also keeps family. You see how he stresses, go out, spend some time with your kids and stuff like that. He just seems like the all around great package, somebody that we can all look up to. So I'm really happy you chose that. All right.
I'll give you a final story to close this off on Harley. His son was our intern at Ice Farm Capital.
Okay.
And we decided to do the standard order food for lunch and give him an eating competition. and so Harley's son had to eat, I don't remember how many, but these like huge dumplings in New York City.
Okay.
Those really big ones that you get in like the food carts. And we ended up calling all our brokers, all our salespeople, and creating a pool of bets on how many he would eat and how he would do. So when you talk about his family, he has a beautiful family. His son was a great.
So did he do it? Was he like? Did he make the cut?
I don't remember if he succeeded or not, but I do remember that he had to go home after. Putting it to you that way. Like after he was done, we sent him home. We're like, go home for the rest of the day, because you could tell he wasn't feeling.
Oh God, those are the worst things.
But we've all done that. We've all done that at some point.
For sure. I always tell people when they're younger, or if you're betting on them, you always take the under. It's always more difficult than people think to eat all those things.
Exactly.
All right.
Yeah.
All right, Danny, it's been a real pleasure having you. Before you go, why don't you tell people where they can find about your Substack? And let's actually start with your Twitter. I'm looking at your Twitter. You're woefully underfollowed. Let's start with that. What's your handle? And, everyone go out and follow. If you're interested in macro, make sure you follow Danny. What is your Twitter?
So it's Danny Dayan 5.
Okay.
It's my random thoughts of the day come out there. Hopefully they're of value. And then, there's a link on my profile to the Substack. It's Macro Musings by Danny D, but the link is there in my profile and you can check it out. I post, whatever I find interesting of the day. There's times where I'm posting a deep dive macro piece into things like demographics. There's other times where I post just quick charts that I find interesting. Other times it's trade ideas, volatility surface and analysis of the option markets, things like that. So whatever I find interesting, I'm posting and also having dialogue with the guys who do follow me. So it's been fun to start this, and certainly welcome more people to join.
Well, Danny, it's been a real pleasure having you. Thank you for making time for us.
Thanks, Kevin. Thanks for having me.
Take care.